Well, good morning and welcome to the Spheria webinar on what small and microcap stocks are set to shine in 2017. Well, firstly, a happy new year to all our listeners and very much thank you for your support during 2016. My name's Mark Cormack from Pinnacle Investments. Pinnacle are equity partners and work alongside Spheria to distribute their Spheria small and microcap funds to the Australian financial advisory marketplace. And joining us today on our webinar are both the founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker. As a bit of background for our new listeners, the Spheria team joined the Pinnacle Investment Group in April 2016 from Schroders, where they managed the Schroders Australian small and microcap portfolios. As many of you will know, the boys have an enviable and long track record of investing in the small and microcap space. And this is reflected and endorsed by the recommended ratings by both Lonsec and Zenith for both the Spheria small and microcap funds. And whilst it hasn't been long, we're delighted to announce that Spheria is already available on a multitude of platforms ranging from Asgard, IOOF, Macquarie, BT Wrap, Netwealth and Hub24. And in total, Spheria are now managing in excess of $170 million in funds. And this really affirms that there's a lot of demand out there for high-quality managers in the small and microcap space, especially as the team has such a credible track record and has capacity to take money. So before we kick off today's session, just a couple of quick housekeeping items. Today's Spheria webinar will last around 15 to 20 minutes and it'll be followed by a questions and answer session. And all attendees will have the opportunity to ask questions. That'll be via the chat box at the bottom of your screen. So without further ado, I'll hand you over to the Spheria portfolio managers, Marcus Burns and Matthew Booker. Thanks, guys.
Hey, good morning. Thank you, Mark. This is Marcus Burns, the co-portfolio manager of Spheria. So today we'll take you through basically a quick summary on where Spheria is in terms of its development, running through some recent performance, take you through a couple of examples, and then give you a bit of a flag about some things that we're looking at and maybe some areas we're more concerned about in smalls and microcaps as a general universe. So a quick recap on where we are today. The group was founded in April 2016 and the three team members that comprise Spheria, we worked together previously at Schroders for over 3 years and really formed a good team, a good unit there and found a good way to work together and extract alpha from both smalls and microcaps. In fact, we think the two funds actually work very synergistically together, providing ideas in both directions. So we have a lot of experience in this space. We enjoy working in this space, and we get a kick out of working together as a team. Importantly, we've actually created a lot of technology we use to cover stocks in smalls and micros. I mean, there's a lot of stocks we have to cover. The universe is very large, particularly in the microcap space, and we employ technology to use both our screening processes and also to actually build models on companies. So we pride ourselves on going deep into companies, analysing the cash flows and balance sheets of the companies and doing valuations. And so, we have to employ technology to help us build models, which we do extensively and rigorously when we're building our portfolios.
That's right, Marcus. There's a myth out there you need a big team to cover Australian equities. But what we think is you need better systems, you need to be nimble, and that's what we've got at Spheria. We've got a 3-man team, but our systems are quite powerful, and we can populate models, financial models, very quickly and come up with a view pretty dynamically. So we don't get bogged down in the bureaucracy that large institutions do.
Yep, and we've flagged this before, but we do have fairly strict limitations on our capacity, both in micros and smalls, and as we approach those limitations, we'll be closing the funds to make sure we can drive alpha for clients. On the next page, there's a quick snapshot of the performance since we formed both funds. So the microcap fund was incepted in middle of May, actually, so there's about 8 months of track record there, and we're pleased with the early performance of that fund so far. Australian Companies Fund basically has had about 6 or 7 months of performance, and again, those numbers are again pretty reasonable. And I guess we're pleased with both funds, just given how volatile it's been in small cap and microcap, particularly in the last couple of months, as we've had downgrades in a few areas. And but more so pleasingly, we've generated the alpha without taking undue risk. And I think this is a real fundamental of how we think and invest in the space, is that we really start with trying to minimise risk first. And so everything we do is about trying to reduce risk for our clients. So we think about balance sheets, cash flows and valuations are the 3 bedrocks of how we think about investing. And as a result, these are good numbers, but also generated with much lower beta and much lower volatility than the sector and most of the peers. So beta, for example, gives some numbers of 0.45 on a microcap fund, so very low beta, and 0.81 on a small companies fund over the last 6 months. So we're pleased with the fact that one of those measures of risk is indicating we do actually succeed in generating good alpha with low risk. And obviously, particularly you've seen in the last couple of months, you've seen some downgrades from things like Aconex, GBST, Osforex, and a bunch of other stocks in the space. Combination of reasons of either high valuations, high expectations that weren't met, or in some cases, in our view, business models that were perhaps flawed that are coming through to manifest and really impact their share prices. Portfolio has a slight tilt to mining services. We think there's good valuation still in mining services and in some mining stocks. We cover all sectors of the economy, all sectors of the small and microcap universe. We don't issue any of those sectors per se. We just require that businesses generate good cash flow and have good valuations for us to invest in them. So that's our criteria rather than saying we're an industrials-only investor. And then lastly, we've benefited recently from 2 takeovers, which I guess happens when you have a portfolio that's got that's focused on cash flows and valuations. So towards the end of 2016, we had Fantastic Furniture across the portfolios, which got bid for by Steinhoff at a good premium and made the funds very good money. And then more recently, in January, we had McMahon Holdings, which received a takeover offer from CIMIC. Again, we think a pretty low valuation, but nonetheless, it's been good for the funds.
Marcus and I were talking the other day about the dot-com boom and bust, and during that period, I covered a company called Computershare. I was a research analyst, and the stock went to, I think it got to an 80 times PE. The stock went to about $10. The bubble burst pretty quickly, and there was a big rotation out of those sort of financial soft assets into hard assets, and that was a multi-year boom, and I think we're kind of seeing that rotation at the moment. Computershare went from $10 to $1.20, and it actually became very attractive at $1.20 back then. So what we're seeing now is quite a shakeout in the market where a lot of those financial assets or those dot-com type technology assets, we think there could be a shakeout. You're starting to see that, and that will create opportunity for us down the track. At the moment, we are definitely biased towards harder assets, and companies in that commodity mining service space are definitely of interest to us. In terms of our process, it's often, everyone talks about buying quality businesses. What is a quality business? I think there's a misconception out there that quality reflects the share price performance. That's not what we're looking for. We'll look for companies that have gone up or down. We'll assess them on their merit, and what we look for is returns and cash flow in those businesses. We particularly like companies that generate good free cash flow. At the end of the day, a company's only worth the present value of its future free cash flows. And so in small and microcap, if you can find that dynamic, you're probably going to do pretty well. Also, if the market does turn down, these companies can self-fund themselves through any downturn. And that's important because from time to time, markets do fall, and you don't want to rely on a share price having to raise money to survive. That's not what we're after. So there's a free cash flow focus. We try and keep open-minded whether share prices are going up or down and try and just get to the facts about a business and find the substance in a business. Markets are definitely inefficient in small and microcaps. We've made money a lot of times buying stuff that people thought was not high quality, but the actual assets were of high quality. Perhaps they were camouflaged by some low quality assets. We've also made money buying good companies that can demonstrate growth, and we'll talk about them later on in this pack. I mean, one of those companies is Class. Just moving on to slide 6. eMerchants is a good example of a company where if you look at that chart, and I'll just preface this by going through the chart, you can see the free cash flow is the red bar historically from fiscal year 05 to fiscal year 16. The orange bar is the EBIT of the company, so effectively the profit before tax. You can see the cash flow conversion is okay. Unfortunately, the company doesn't earn any money. It hasn't earned any money over that time frame. In 16, it made a smidgen of cash flow. If you look at the metrics around EML, the company's valued at nearly 400 million of market cap. It is a transaction processing business, a financial type business, and it hasn't generated a profit, and yet the market highly rates it at $400 million. We think there's a lot of risk in that share price, and we think there's risk in those sort of companies in the market at the moment. We're staying away from companies like eMerchants and a lot of the sort of other financial type assets and dot-com assets which don't make any money. We think there's a lot of risk in that space.
Yeah, and just to add to Matt's point there, the real reason for this is not that we don't necessarily believe the technology could come to fruition or be of value to people, but we look at the smaller end of the marketplace, and the reason cash flow is so important to us is that if there's a downturn or a risk-off event, as people call it, these companies need to come back to the market periodically and tap the market to raise fresh funds to keep funding the business. And if the market knocks the share price down materially, they can't actually raise the money to stay in existence. And so we highlight that these sort of businesses are at risk in a downturn, and we don't want to own those sort of companies for our clients, and we think that we'll do better by screening the risky ones out and focusing on ones that create cash flow and have attractive valuations. So in contrast to eMerchants, one we do own is a business called Monadelphous. This is our small companies fund. Monadelphous is a mining services business, does both construction and maintenance in the field. It's got a very, very good management team that also focuses on risk control. And as you can see from the cash flow conversion, again, back to Matt's point, the dark bars in this chart show the historical free cash flow before interest and tax, which we compare with the EBITDA. And those numbers should match up over time if the quality of earnings and the cash flow are really good out of the company. And you can see the average over the last 15 to 20 years from Monadelphous is close to 110%. In other words, it converts almost more than all the earnings to free cash flow, something we think is very attractive.
The only issue with Monadelphous is that it's been in a cyclical downturn. So mining capex peaked as a percentage of GDP a few years ago, around 8%. We think that's starting to bottom out. You're seeing the mining cycle turn favourably, and we think Monadelphous will be a beneficiary. So it is a cyclical business. That's the one factor against it, but it is a very well-run business. If you look at the returns, the cash flow it produces, it's probably the benchmark in the industry from that perspective.
Absolutely.
And the other dynamic that's improving for them is one of their competitors, UGL, was taken out by CIMIC. You saw recently that CIMIC has terminated the power station contract at Ichthys. UGL also had a contract on the trains up there, a big contract. We think Monadelphous, being one of the few players in the market that can complete that work, will be the beneficiary by winning some of that business up there, which will keep their order book up and means that they'll generate good earnings over the next few years as the cycle turns in terms of the capex cycle.
That's right. And the other, just to finish off on this chart, the other interesting point about Monadelphous is that as the business used to be very heavily weighted to construction. If you go back 3 or 4 years during the mining boom, something like 70 to 80% of the revenue came from construction, sort of very one-off-ish in nature, but obviously related to the mining boom. And 20 to 30% of the revenue came from maintenance, in other words, a 3 to 5 year contract to maintain an asset like a gas train. So much more recurring revenue stream. And as the business has shifted, so you've had the capex cycle come off, and conversely the maintenance cycle increase, that revenue mix is now split to about 50-50. So in other words, the quality of earnings and the durability of the business has actually improved bizarrely whilst the stock got derated. So that's one example, back to Matt's point about trying to look through the numbers and the noise and see how the actual underlying business is shifting over time. And if that's improving, with an improving valuation, we get very interested as investors.
When we initially took our stake in Monadelphous, the market cap of Monadelphous was $550 million. It had $200 million of cash in it, so we were paying $350 million of enterprise value for the business. It had $70 million of EBIT. Obviously that EBIT had cycled down, but we thought had rebased. If you compare that to eMerchants, we're buying a business then that had $350 million of business value effectively. It was generating $70 million of EBIT, which we think was bottoming out, versus eMerchants, which doesn't make any money and had a similar, actually a greater market cap now. So what we're saying is that on a relative basis, you can see quite obviously that Monadelphous is much better value than a company that is built on a concept.
Yeah, I think so. It's a good point, Matt. Turning the next page, we've got another example here of a high growth company we do actually own in the funds. Just in case you think we don't like buying growth businesses, we like buying them at what we think is an attractive price. I think, back to Matt's point, I think people sometimes, not always, sometimes make the mistake of considering quality companies as high growth companies. So if the revenue of the company is growing quickly, we think some people look at that and say that's a high quality business. It doesn't always necessarily mean it is a high quality business, especially if they can't convert revenue growth to earnings and cash. Class, which some of you are probably aware of, is the leading SMSF software provider. It's a cloud-based solution, and basically it monitors portfolios and helps prepare tax returns for accountants. It's got a very, very recurring revenue base, something like 99% plus of the users re-sign in the following year, so almost no churn. And it's visibly taking market share in the SMSF space. So on the right-hand side of that graph there, you can see the total SMSF portfolio, so the dark blue bar. which is around about 600,000 users, and Class is currently 128,000 odd of that. So, whatever that is, 22%, 23% of that market, and growing every year. Importantly, within the SaaS business, so as that market moves from desktop to cloud, they've got something like a 65% market share of that cloud product. So, most businesses are shifting to cloud for a bunch of reasons, and as they take that, we think Class will be a massive winner in that space. Equally importantly, on the left-hand side of that chart, you can see the two bars there showing the historical cash flow conversion, both the earnings and the cash flow conversion, which are really good. So it's got a net cash balance sheet, it generates great cash flow, very recurring revenue stream, and growing, 30 to 50%, 30, 40, 50% revenue stream. So
we think it's going to generate profit before tax this year of about $12 million, which will be up well over 50%. And if you compare that back against eMerchants, eMerchants doesn't make any money. Class is growing organically. It's visibly growing. It's visibly taking market share. There's industry data to support that. And, you look at the market cap of eMerchants, again, is $400 million. Class is less than $300 million. It's got $12 million of EBIT. It's converting that EBIT to cash. It's got no debt. It's got all the hallmarks of business that we will pay up for.
Yeah. I think we're not just singling out eMerchants there. There are actually a number of sort of technology and payments related stocks in the small market space that have market caps of $400 million and no earnings. I kind of joke that they're part of the 400 and 0 club, 400 million of market cap and $0 of earnings. And there's a number of those out there, some of which have recently IPO'd. And we're not saying they won't succeed or they won't create value for shareholders over time, but we just think that at the moment, until they can create cash flow, they're a very risky proposition, and we don't want to own them until they create earnings and cash flow and the business model's proven.
If you buy a portfolio of those sort of assets, the probabilities are weighted against you. We like to skew the probability in our favour, so we're going to buy companies where we, obviously that they're producing cash, and the probability that they're being successful or they have been successful is already obviously easier to capture.
Yep.
Moving on to the next slide, just Royal Wolf. So it's the leading player in the portable storage market in Australia. We have spoken about it in the past. It is in a turnaround phase. It has been in a cyclical downturn. In the past sort of mining boom, infrastructure boom, the stock went to $4. It's now trading around $1.50. We entered the stock in the low $1. The market had kind of given up on it. It is producing good cash. It should produce more cash going forward as utilisation of the storage units improve. We also think it's a very strategic asset. There's be a lot of players that would be interested in buying the business because of its market share, because of its geographic spread. There's a lot of strength to the business, and so we wouldn't be surprised if it did become the target of an acquirer at some point. But putting that aside, the business we think is going to generate good cash over the next few years as the utilisation improves, and you're buying it pretty much a discount to book value.
So I think we should just flag that we don't necessarily buy businesses we think can be taken over. We buy them because they tick our fundamentals. The cash generation is good, balance sheet and valuations. The three bedrocks we discussed before are all ticked off. And typically, not always, but sometimes that is also attractive to an acquirer, as McMahon's was, as Fantastic Furniture has been historically, and we think Royal Wolf and a few other stocks we have in the portfolio would also be appealing to either private equity or foreign firms as they come into Australia.
Just moving on to slide 10 themes. We talked about concept stocks. The great NRL coach Wayne Bennett said nothing good happens after midnight in the footy, and that's very true. We think nothing good happens after 50 times in terms of the PE ratios. And you're seeing that at the moment. A lot of stocks that had a lot of big expectations in them are unwinding pretty quick. They're trading at big multiples. We've seen this in the past. We think there'll be a continued rotation into companies with cash flow, with hard assets, etc. We think we're in a bit of a multi-year boom in terms of that rotation. We believe that M&A activity will be elevated. Obviously, private equity is awash with money. They've raised a lot of money over the last few years. And corporates lacking growth, the big corporates and multinational guys will start to look down into the sort of mid-small cap space. So we think there'll be more M&A. Hopefully, we're a beneficiary of that. Buying companies that have free cash flow generally positions you for that M&A type activity. But as Mark has said, we don't do that. It's not a primary aim, it's a secondary outcome for us. Resources and related sectors look definitely attractive to us. We think commodities will mean revert. A lot of them still are, whilst they've recovered from their lows, they're still well below cyclical highs. So we still think there's a recovery on that front. We think it's important to be across all the sectors, and Spheria covers all the sectors. We cover resources, we cover oil, we cover technology. We're across those sectors. We have good diversity across the portfolio, and we think that will hold us in good stead going forward. As we discussed before, free cash flow, strong balance sheets and valuation remain the bedrocks of what we do, and we think that's translating through to the performance.
Excellent, guys, and look, certainly appreciate your insights and thoughts into the small and micro-cap space for 2017. Just a reminder that all attendees do have the opportunity to ask questions, and that's via the chat or the questions box at the bottom of your screen. Just while we wait for a couple of questions to come in, I just thought I'd reiterate a couple of the key points I made on Spheria from some of the feedback that we've received over the last few months. And I think one of the common points raised by advisors to the Pinnacle team has been that finding high-quality small and micro-cap fund managers who do have a track record of outperforming and do have capacity is scarce. And in addition, when you look at the team's track record in small and micro-cap investing, it has been exceptional. So if anyone is wanting access to Spheria, whether it's on your APL, via your dealer group, or via a platform that we're not yet available on, I'd certainly encourage you to reach out to the Pinnacle distribution team, because we certainly want to ensure that you have access. Look, while we've been talking, there have been a couple of questions come in. Excuse me. There's some great stock stories in the presentation. Do you guys have a view on market valuations at the moment?
Matt's pointing at me when this question comes up.
Also, no, there's definitely pockets of exuberance in the market, and we talked about some of the technology space where there's no earnings and there's big market valuations. The telco space, there's a similar type story.
Has been, yeah.
Anything else to say?
Yeah, look, I think the index level, index valuations are always below what's going on beneath that. So, Matt and I would say that we've seen pockets of valuation. Some of the IPOs that occurred in 2015 and 16 were a bit concepty, or had a good run up on high sort of revenue growth without cash flow coming through. Most of those are kind of washed out or in the process of being washed out. So we don't see the market as being particularly cheap, but we see some opportunities in areas that are less popular. And as Matt said, we're making sure we don't get involved in areas where we see no cash, no earnings, and a very high multiple of revenue or something like that. So, yep.
I'll combine a couple of questions here. Where do you guys see areas of risk in the small and micro-cap market? And you mentioned a couple of stocks at the start that blew up, and one of the other questions that came in was you guys invested in Bellamy's when you were at Schroders. What reason wouldn't you look at the stock at now?
Great, I'll take that one. Okay. So we did buy Bellamy's at Schroders. Thank you for remembering that, whoever did that. We got involved at $1 when it IPO'd, and it obviously went as high as $13 or $14 over time. We were progressively selling out as that stock got re-rated. We would look at it again. We don't, as Matt said, we don't. In fact, we like to revisit stocks, especially when they get washed out aggressively. And we think it's a good brand and ably run. So it's definitely on our screen. What slightly concerns about Bellamy's at the moment is that there's a very large working capital position, both in the company and in the trade, and that takes a lot longer typically than people think to work out. And as that works out, the discounting, there's potential for brand damage as that period gets washed out. And they now have signed up take-or-pay contracts with 2 milk processors in the country, Bega and Fonterra, which obviously do saddle them with some potential liability. So we're watching the business. We do like the brand. We're just cautious until we've seen exactly the damage done through the brand value as they discount. So yeah, it's on our watch list.
It seems too early to us.
Yeah, and so the rest of the question was.
The rest of the question was just areas that you see in terms of risk in the small and micro cap market.
Sorry, we didn't cover that. So yeah, we still think that anything that's part of the 400 and 0 club, as I call it, Matt rolls his eyebrows at me, where we see a lot of market capitalisation, a lot of forward value given for concepts without any proof of business in our mind, because businesses prove to us when it generates earnings and cash flow. We see high risk in those areas. There are other areas of the economy that are struggling a bit, retail right now, but we think they're more cyclical in nature. So, high valuations, no cash flow is always a high risk to us, and technology and telcos are still an area we see major problems. Small finance companies still have a problem in our view. We think bad debt cycle could wash out. They are highly reliant on the share price to raise capital consistently through the period of time. There's a number of those in small cap land that do mezzanine finance or receivable finance, which are high risk. Matt, anything else that you'd see?
Yeah, definitely those financial lenders out there. There's a lot of risk in them. They borrow money to lend money out, and they need to raise equity, as Mark has said. So it's kind of circular. If the share price falls, you can't raise money at the right price, and you go out of business. We don't want to get involved where those risks are skewed to the downside.
Yeah, and I'd say one last thing. Any business that gets greater than 50% of its revenue from the government, childcare, aged care, healthcare, they can be good companies, but we remain we look very carefully at those for reg changes and abuse of the system. And if we see potential for that, we don't get involved. So they typically are areas we see high risk as well.
Yeah, we think there's a lot of risk around the aged care space. A lot of the players that have listed in the market have taken advantage of the government through the ACFI funding instrument, and clearly that's being shut down at the moment. They're reducing, the government's out to reduce that cost and reduce the returns in that space. So you're going to see a big earnings crunch in that space. We don't think you'll see insolvency. You'll just see earnings fall precipitously, which will affect market valuations.
Excellent, guys. Do the funds participate in IPOs or alternatively take a watch and see approach?
Look, it just depends. I mean, we consider everything as an investment. That's what we said. We're open-minded. We go through every IPO. We are reluctant to buy IPOs from the private equity space. We do think you're buying from an insider, which can be dangerous. But we definitely consider all options, IPOs, whatever. We just don't write anything off. We do the homework. We validate it. We just try and work out whether there's substance, and we work out what the company's worth.
Yeah, two things to add to that. One, when we went back and looked at our participation rate in IPOs over the last 2 or 3 years, it was about 1 in 10. So we definitely did go for some. So Bellamy's was one, actually a good example of one we went for 2 or 3 years ago. Beacon Lighting is another one we went for. We like the family there and the business model and the structure of that company. And a few others we've gone for. So we don't necessarily eschew them. We look at them all. We like to have a good history of earnings to kind of work out what's going on. We don't like pro forma earnings, pro forma, schmo forma earnings, and we like a good history and a good structure and a good vendor basically and a good valuation. So we do, but we're selective about that.
Guys, just another question on capacity for the smalls and micros.
Yep. Yeah, we've discussed this publicly that the microcap fund we're looking at about 250 million is the maximum. However, we reserve the right to close it early if it is impacting performance. We ran about 120 million at Schroders in the micro fund, and that was very comfortable. So we think we can push above that, but we'll wait and see. And the small cap fund, we have said publicly around 700 mil maximum. Again, it's the same as the micro fund. If we think the fund is impacting performance, we'll close it early.
Yeah, but both those numbers, if you combine them, are probably lower than some of our peers in the space. That's deliberate in our view. We want to make sure that we continue to drive alpha with clients. Where Matt and I and Adam are highly competitive people. We want to make sure that the returns for clients are really good over time. And ourselves, we're also all in the funds, by the way. My family's in the funds. It's important we perform, or else we have no families, no friends, no job. I'm kind of joking, guys. But also I'm serious about that. We're passionate about that. So we do limit the fund, and as Matt said, we will close early if we think it's impacting performance.
And guys, where are you sitting at the moment in terms of getting towards that fund with micros and smalls? The size of the fund?
Yeah, total we're at 180 million. We said that at the start. Probably 16 of that is in the microcap fund. So the microcap fund started from scratch, whereas the small cap fund started with a certain amount of money, so it had scale to begin with. Look, the microcap fund is seeing strong inflow, so is the small cap fund in terms of retail. There's strong demand out there, so that's growing pretty quickly.
Yeah, and look, we only just went on the platforms that you see on your screen there in November, so that and then we obviously had a seasonally quiet January period. Another question here on cab charge. Why are you so bullish on cab charge with Uber taking such a market share?
Yeah, look, Uber is probably around 10% of the market at the moment. So the cab industry still exists in a big way, so it's about 90% of that market. Rank and Hale is still protected, and we met with Uber a couple of months ago, and they said to us the convenience of walking out of a building and jumping in a cab is something we'll never compete with. So that Rank and Hale, which is probably 3/4 of taxi rides, is here to stay, and that's big volume. So cab charge, what they're doing now is they lost market share probably 10 years ago to a lot of the terminal players. They're looking at regaining share by putting out a driver terminal, and that's getting early wins. So they're starting to get some market share growth through that terminal rollout. So we think they can take market share within that 90% of the market, and that will drive earnings growth down the track. Obviously, in the short term, they've sold the bus business, which we're very happy with. We think they got a good price. They'll be able to release significant franking credits in the business. I think there's about 78 million of franking credits in the cab charge business. They'll have 100 million of net cash after the sale of the buses. So you're looking at a potential capital return of $1 or thereabouts, fully franked, which is pretty substantial. The company will still have a good balance sheet post that, and the actual terminal business, that is the core part of the business, will still earn anywhere from $30 to $40 million. Clearly, if they can drive market share up within that terminal usage, they can drive that earnings up as well. So it's not cataclysmic for cab charge. We think they're executing pretty well, and the management team, I think you'll see some good runs on the board over the next few years.
Okay, guys, a question. Any gold, lithium, cobalt exposure? What do you guys go into? Would you guys go into a sector that's perceived as risky?
I'll take it on.
You might.
I mean, the answer is yes. If the business will generate cash flow, if we find a cobalt, lithium, what's the other one? Or gold, or any other base metal or rare metal, or rare earth, in fact, which, as we all know, is not that rare. But if any of those businesses, produce, good cash flow, have sound mine lives, and aren't overgeared with an attractive valuation, we'll buy them. It's as simple as that. And if we can understand them, that is. Matt, do you want to add to that?
Yeah, look, we own Independence Group, which has the fantastic gold mine in Tropicana. It owns 30% of that asset. It's pretty long life. It's pretty low cost. It's high grade. I mean, the grades are above 2 grams a tonne. They also own Nova Bollinger, which is probably the biggest part of the valuation. And Nova Bollinger, one of its byproducts is cobalt. I don't think there's any lithium there, but you can buy good quality assets like Independence Group, which is obviously well owned amongst the small cap community, but it does have that exposure in it.
Yeah, we find amongst smalls and micros that a lot of the smaller names tend to be deposits only, with someone on top telling you a good story. So once there's lots of commissioning risk, capex blowouts, typically political risk. I could go on. So if those things are behind us, we might be interested in them. But typically, if there's a lot of risk ahead of us without a proven ore body, we would probably wait.
Yeah, a lot of the companies, they just have a single type exposure like zinc or cobalt. At Independence, we get gold, we get cobalt, we get nickel, we get copper as well, and some zinc as well. I mean, it's got everything you could possibly imagine, and it's making cash flow. So why would you take a speculative exploration company when you can buy the real thing?
Excellent, guys. One last question. Did you participate in the Class IPO? If not, what changed in the Class business to justify entry?
Yeah, we did participate in the IPO. We got, I think it was 1 million shares when we were at Schroders. Clearly, we left Schroders, so we left that holding behind, although some of it did come across with one of the mandates which came across, so we still have a little bit of that exposure from the IPO. Obviously, it was very inexpensive when it IPO'd. The business has just gone on from strength to strength. I mean, it's got 127,000 SMSF users now, and we think that can get up to, say, 50% of the market. If they get to 50% of the market, they'll have 300,000 users. 300,000 times $250 per user is quite a lot of money. You're talking about $75 million in revenue. With the scalability of the business, you're talking about costs potentially rising. The fixed costs in the business are pretty small. They might not go up much. You could talk about this business earning 50% margins down the track. On 75 million revenue, you're talking about over $30 million of EBIT down the track in the next few years. And you put that on a low multiple of 10 times, you get well above the current share price.
Excellent, guys. Look, thank you for today's presentation. Hopefully it gave everyone a great insight into the thoughts in the guys' minds with respect to the small and micro cap funds. Appreciate your comment on the Broncos there, your analogy there, Matt, and hopefully we can convert you into a Maroons supporter come State of Origin time.
Only the Blues, mate.
But we will be making this webinar available on the Spheria investment website, which is www.spheria, and that'll be available later this afternoon. We'd certainly like to thank everyone for their participation and questions in today's webinar. If you do have any further investment inquiries, please do not hesitate to contact the Pinnacle Investment team. You'll see our contact details on the screen there. And we certainly look forward to either chatting with you on our next webinar or in your offices. Thank you very much for your time today, and have a nice day.